Hello folks, Steve Lentz here with Discover Options here at Option View. Welcome to this edition of 3 different market timing reports for advanced options traders, particularly for the S&P 500 cash index options. This will be for Friday, December 29th, getting ready for Tuesday's open on January 2nd, 2018. Presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get to the reports, just a reminder that you can get a free ebook from us, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click the link, give us your information, we'll get that right out to you. And also, if you could click the subscribe button, that way you'll get you'll get notified whenever we come out with a new video. We'd love for you to be a subscriber and get alerted to that. We have 3 reports for you today for the premium sellers using market-neutral strategies like condors and butterflies. We have the S&P 500 Condor Butterfly Timing Report. For those that trade the S&P 500 primarily by selling puts through the use of bull put spreads, even naked put options, we have the bull put spread timing report. Both of those reports answer the question, based upon the current market condition, is now a good time to use either of those strategies. So we're going to look at that. And then for the statistically minded, we have the S&P 500 directional likelihood report answering the question based upon the past incidences of the current market condition, where's the market likely to go? Okay, let's get right to it. The current market condition looks like this. We are in an uptrend above the 50-day simple moving average. In terms of price action, we had an upswing bar on Thursday and then an outside bar on Friday, a substantial outside bar with a higher high and lower low. See that? Now, all that happened with the stochastic trending downward beneath its percent D, 3-day percent D, the 53 stochastic that is, and it's between 60 and 100. Okay, so in the overbought territory, but trending downward. Okay, now, this is the current market condition. It's occurred roughly 40 times in the past. That's not too, since January of 2000. That's not too often, but that outside bar is what really is, you just don't see a whole lot of outside bars like that occurring when the market is in an uptrend and the stochastic is in a downtrend. It just doesn't happen that often. When it does, though, let's take a look and see how these strategies would fare. So here's the Condor Butterfly Timing Report. Since Jan of 2000, we've had over 4,500 closes of the S&P 500 since Jan of 2000. Now, of those 4,543, almost 2/3, 65.4%, almost 2/3 have been favorable bars for selling options premium where the actual subsequent 21 bar movement was less than the SIBO skew adjusted implied movement. That means basically that the market did not move as much as what the options prices were implying. Okay, 2/3 of the time. You can flip a coin 2/3 of the time. You'll end up on having a good bar to do these kinds of strategies, condors or butters. Also, during that same time, our current market condition, okay, that we just went over, that's detailed below like here, our current market condition occurred 40 times. Of those 40 occurrences, 79.9% have been similarly favorable for option premium selling. That's quite a bit higher than the benchmark of 2/3. Quite a substantial amount, in fact. This implies an option premium selling edge of 14.5%. That's pretty darn good. Okay, so statistically, it's more likely than usual that our current market condition will end up being a favorable one for selling option premium through market-neutral techniques. All right, that's the Condor Butterfly Timing Report. Now, for those of you that like to sell put premium, a standard deviation away, 30 days out, something like that, this is the bull put spread timing report that makes that assumption. And so since Jan of 2000, we've had, as I mentioned, over 4,500 occurrences or closes of the S&P 500. Of those, 83.3% have been favorable bars for selling put premium, where the actual 21 bar downside movement, the most that it went down, the actual downside movement, was less than what the options were implying through their prices. That is the SIBO skew adjusted VIX, or the implied movement coming from the VIX. Okay, so 83.3% of the time the market did not move down as much as what the VIX was implying. All right, so you could flip a coin, pick a bar. 83.3% of the time, you'd end up on a bar that would be a good one for selling put premium, where the market did not touch your short strike down there if you sold it a standard deviation away 30 days out, 30 calendar days. Now, also during that same time, our current market condition occurred 40 times, and of those 40 times, get this, almost 95% of the bars were similarly favorable for that kind of put premium selling. This implies a huge edge of 11.6%. So statistically, it's more likely than usual that Friday's bar will end up having been a favorable one for selling out of the money put premium. So both reports, condors and butterflies, bull put spreads, looking like the market condition is fairly favorable in that regard. If the past, behavior of this market condition plays out, is it guaranteed? Well, certainly not. Okay, we just know that when this market condition occurs, it's more likely than normal. The benchmark historical, it's more likely than normal that it will end up being favorable. Finally, we have the market likelihood report. This answers the question, based upon past occurrences, those 40 occurrences, where is the market likely to go? Up, down, or wobble around for a bit? To answer that, we have to use price distribution bands, where we take a point, a standard deviation away from the close, like you can see here. Okay. You can see this is the standard deviation away 5 days out. On the upside, this is a standard deviation away to the downside 5 days out. Now I'm using the SIBO skew adjusted VIX for the upside and the downside. These are different values. The VIX is one value. I like to use the SIBO's skew published number to delineate between upside implied movement and downside implied movement. Because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts, the upside band is closer to the close than the downside band. You see that? Okay, so the question is the market going to go up and hit the upper band, the lower band, or wobble around and hit neither of the bands? We look at every close going back, all 4,500 of them, and do the statistics not only for the 5-day band, but also the 10-day bands and the 15-day bands as well. So when you look at the numbers here, here's what you got. Over the 4,543 occurrences, the upper band was struck 21.6% of the time, the upper 10-day band 16% of the time, the upper 15, 15.2%. On the lower side, the lower band 16.4%, 16.6%, the lower 15, 19.3%. Now, here we had this scan counted 41 occurrences of our current market condition. Of those 41, the upper band was struck 12.2, which is a lot less than the 21.6, which is the historical benchmark. So that's a difference of 9.4%. That's pretty substantial. The upper 10-day band was struck 14.6, which is less than historical. The upper 15, less than historical. On the downside, the lower 5-day band, look at that, it was struck only 2.4% of the time, much less. 7.3 on the lower 10, 4.9 on the lower 15. So do you see a pattern here? You see that the all 6 bands were struck less often. The lower bands were struck far less often than the upper band. So if you're going to lean this thing, if you're going to lean your opinion in one direction or the other, you'll note that the lower bands were getting struck far less often than the upper bands. So you would lean this slightly bullish. Slightly bullish. Okay? So just bear that in mind when you look at, you can see a clear pattern here. All in all, though, you have a picture of lower market volatility. If you have to lean it, you would lean it bullish because those lower bands are getting struck so seldom relative to the upper bands. But altogether, you have a picture of lower market volatility. Now, one thing I like to do is carve this up in terms of, when we get to Tuesday's open here, if the market goes above Friday's high or goes below Friday's low, I examined what's the distribution in each of those cases. Now, in this case, we only have 10 incidences where it exceeded that previous bar's high. We only have 18 where it exceeded the previous bar's low. And we have roughly 13 occurrences where you had an inside bar where it did neither, apparently. When you look at 41 and then you look at these others, it's pretty apparent that you have a whole lot of bars where it didn't count, meaning that it was an inside bar. So we're not going to look at those, but if you did look at the 10 and the 18, that's just not a huge population to look at, but if you had to, just take a look at the numbers. The upper bands were struck very seldom. The lower bands were struck seldom, but a little bit more than the benchmark. But again, just not too many occurrences here to hang your hat on. In fact, on the lower side, these were struck more often out of those 10. But because these are such few occurrences, and you have, the same amount of bars pretty well that didn't even count, I wouldn't even look at these. I would just, base any decision you have on the 41 and call it a day. You had 18 occurrences of the market going below, in this case, Friday's low, and 5 of the 6 had lower values than the historical benchmark. Okay? So I hope that information helps you a little bit in your decision making, and hope you're staying warm. I know in the Chicago area it was -7 this morning when I had to go driving out and about. I hope you're staying warmer than we are. I'm Steve Lentz with Discover Options. Happy New Year, everyone. Have a great week and a great New Year. Take care. Bye-bye.